After more than a decade navigating a legal minefield, enduring relentless political pressure, and pushing through a series of stalled mega-projects, Canada has finally unleashed its ace on the global energy chessboard. From the wild yet resource-rich coastline of British Columbia, a brand-new LNG export corridor has been activated. It sends Canada's natural gas racing across the Pacific Ocean, directly into the energy-hungry markets of Asia, and more importantly, ushering in a new era where Canada no longer lives in the shadow of the United States. This is not just a commercial deal. It is a declaration of power, a bold statement that Canada is ready to compete head-to-head with the world's LNG heavyweights, and will not allow Washington to monopolize influence in the region. On June 30th, 2025, in the port town of Kitimat, British Columbia, the history of Canada's energy industry turned a new page. The very first West Coast LNG export shipment departed from the LNG Canada terminal carrying tens of thousands of cubic meters of super-chilled natural gas to Incheon, South Korea, bypassing the Panama Canal entirely, a notorious bottleneck that has long made U.S. LNG shipping slower and more expensive. This new route not only cuts transport time in half from 20 days down to just 10, but also avoids the risks of congestion and massive transit fees at Panama. It marks Canada's opening move to penetrate directly into the world's largest energy markets, without relying on U.S. infrastructure or shipping schedules. Valued at 40 billion Canadian dollar, over 29 billion USD, LNG Canada is the largest privately funded energy project in the nation's history. Phase 1 boasts a design capacity of 14 million tons of LNG per year, MTPA, equivalent to more than 1.8 billion cubic feet of gas per day, enough to elevate Canada from a regional supplier to a global exporter. Oil and Gas Journal hailed the maiden voyage of the Gaslog Glasgow as an energy declaration of independence, a landmark proving that Canada now has the ability to export directly to strategic partners, no longer locked to U.S. pipelines as it has been for decades. Before LNG Canada came online, the nation's natural gas industry was almost totally dependent on the United States. In 2024, an average of 8-9 billion cubic feet per day flowed across the border, generating roughly 8 billion USD in revenue. But this dependence kept Ottawa perpetually on the back foot, vulnerable to policy maneuvers and tariff strikes from Washington, especially under protectionist administrations. Kitimat broke that chokehold. With its strategic location on the West Coast, Canada can now deliver LNG to Northeast Asian ports in just 10 days, twice as fast as the 20-day route from the U.S. Gulf Coast. By avoiding Panama, costs and disruption risks are slashed, giving Canada a competitive edge that U.S. rivals simply cannot replicate without overhauling their entire export infrastructure. According to TradeWinds News, the combination of speed and supply stability is a weapon that instantly positions Canada as a high-value supplier for major buyers in Japan, South Korea, and China, economies rapidly shifting from coal to LNG in a bid to cut carbon emissions. The impact of Kitimat on the United States is not just about lost contracts, it's about a loss of strategic position, loss of port and logistics revenue. In the past, LNG Canada shipments often had to pass through U.S. LNG terminals for liquefaction and re-export. According to the U.S. Maritime Administration, each LNG vessel calling at a U.S. port generated an average of $300,000 USD in port and pilotage fees, excluding insurance and storage charges, by exporting directly from Kitimat. Gulf Coast ports lose tens of millions of dollars annually just from these services, not counting ancillary income. Loss of price control. LNG routed through the U.S. is typically priced off Henry Hub, allowing Washington to influence international prices. Direct exports from Kitimat are tied to AECO pricing, which is 0.50 to 1.50 USD MMB2 lower. In July 2025, the gap reached 1.8 USD MMB2, Henry Hub tilde 2.90 USD, AECO tilde 1.10 USD. With Phase 1's 14 MTPA capacity, this price advantage is worth an estimated 1.2 billion USD per year for Canada, forcing U.S. LNG to cut prices to compete. Loss of premium market share. Asia, especially Japan and South Korea, is willing to pay top dollar for reliable, flexible supply. In 2024, this group accounted for nearly 50% of all global long-term LNG contract value. International Gas Union. Canada's entry means the U.S. loses a share of this gold mine of profits. The result, every LNG cargo leaving Kitimat doesn't just carry gas. It hauls away millions in revenue, strategic market share, and bargaining power from the U.S., pushing Washington onto the defensive in the very capital of Asian LNG trade. LNG Canada is not just an energy project, it's a turning point in the economic history of the Haisla people. Instead of standing on the sidelines, the community has taken a majority stake, over 50%, in the Cedar LNG project, a liquefied natural gas export facility with a capacity of 3.3 million tons per year, MTPA, equal to 400 million cubic feet of gas per day. Once operational in late 2028, Cedar LNG will become the first LNG project in the world under Indigenous majority control. This means the Haisla are not just collecting land leases or compensation fees like in traditional energy projects. They have a seat at the table, shaping the entire development strategy, from signing export contracts to setting environmental policies. The economic impact is massive. According to the BC Ministry of Energy, Cedar LNG alone could create over 500 direct jobs during construction and generate tens of millions of Canadian dollars annually for the Haisla community from operational profits. Kitimat, once a struggling industrial town after the paper mill shut down, is now hailed by the media as the liquefied gas capital of Canada. The port is bustling again, hotels are fully booked, and local businesses are booming with supply orders. It's a rare global example of an Indigenous community not being left behind, but becoming an economic power center on its own land. Canada is promoting LNG Canada as a green LNG giant, boasting a carbon intensity of just 0.15 TCO2 per ton of LNG, up to 42% lower than the global average, 0.35 TCO2 ton. The secret lies in harnessing clean hydroelectric power from BC Hydro, dramatically cutting emissions during the liquefaction process. But these impressive numbers cannot hide the harsh reality. Even in its startup phase, the system experienced flaring, burning off excess gas, sending towering black smoke plumes tens of meters high over the skies of Kitimat. Beyond the pungent odor, this threatens the salmon ecosystem of the Kitimat River, a lifeline and cultural anchor for the Haisla people for generations. Environmental groups such as the Pembina Institute and Sierra Club BC warned that emissions from extraction and gas compression, especially benzene and formaldehyde, could accumulate in the environment, causing long-term health impacts. Medical studies indicate that prolonged exposure to these compounds may increase the risk of chronic respiratory diseases and may even be linked to birth defects in newborns. This creates a paradox for Canada. If it wants to be the green flag bearer of the LNG industry, Ottawa must not only have clean technology but also address environmental impacts at every stage of operations. Otherwise, the image of a green LNG giant could quickly crumble under the weight of black smoke photos and grim health statistics. Prime Minister Mark Carney and the coalition government have unveiled a plan to shorten the approval timelines for strategic energy infrastructure projects, while still holding firm to Canada's climate goals. It is a deliberate balancing act between boosting export growth and honoring environmental commitments. Notably, Petronas Canada has rejected rumors of pulling out of the joint venture, reaffirming it as a long-term investment that leverages low-cost gas and the short shipping distance to Asian markets. However, technical issues with the gas turbines and the cooling system have kept Train 1 running at under 50% of its design capacity. One cargo even diverted to Peru, underscoring the project's early instability. Management insists this is normal for large-scale projects and pledges to fix the problems to accelerate output. Bottom line, the LNG shipments leaving Kitimat are not just opening a new shipping route, they are a declaration of trade war with the United States, a passport propelling Canada into the energy superpower club, and a test of Ottawa's ability to expand exports while staying green. Meanwhile, in Washington, every Canadian LNG cargo is knocking on the door of each contract, each market share, and each dollar of profit, signaling a North American LNG battle that has only just begun and will be relentless. By the end of July 2025, global trade experienced a significant shift, particularly in the relationship between the United States and major trading partners, including the European Union and Canada. U.S. President Donald Trump, known for his tariffs first, negotiations later approach, secured a framework agreement with the EU after weeks of tension.
And $600 billion worth of investments into the United States over and above what they have. And I think that basically concludes the deal. I mean, those are the main factors. I don't think there are too many other factors, other than we're going to get along great.
A 15% tariff on most products imported from the EU was the central element of this deal. The EU agreed to this deal in an effort to avoid a full-blown trade war, which would not only harm their economy but also disrupt global supply chains. However, even after reaching an agreement with the EU, the Trump administration continued to pressure Canada, threatening to impose a 35% tariff on imports from Canada unless a trade deal was finalized soon. What's particularly noteworthy is that while the EU made concessions and signed the agreement, Canada took a different route. Canadian Prime Minister Mark Carney rejected Trump's proposed trade deal. Moreover, Carney publicly expressed Canada's reluctance to accept terms that would be unfavorable to the country, even as the U.S. increased pressure through tariffs. Carney's rejection of the trade deal wasn't an unexpected decision. Since taking office, Prime Minister Carney has demonstrated a clear strategy focused on protecting the nation's interests. This is evident in his firm stance against accepting agreements that don't benefit Canada, even though trade negotiations between the two countries are happening in an extremely tense atmosphere. In interviews, Carney emphasized that Canada will not sign a deal unless it safeguards our economy and national interests. This approach has helped Canada avoid getting stuck in vague agreements, unlike what happened with the EU and Japan. Carney has made it clear that despite pressure from the U.S., Canada will not blindly make concessions. Instead, he has chosen to protect strategic industries like automotive, energy, and digital trade. Carney rejected the U.S. demand to expand access to the automotive market with high tariffs. The Canadian automotive industry contributes $70 billion to GDP and provides 500,000 jobs, so Carney could not accept terms that could weaken this sector. Carney rejected the agreement that would require Canada to sell oil and gas at 20% below international prices. The energy sector is worth approximately $50 billion annually, and rejecting this deal protected Canada's long-term benefits from its natural resources. Carney rejected the U.S. request to open the market to American tech companies and allow them to collect data on Canadian citizens. Canada's technology sector contributes $40 billion to GDP and creates 200,000 jobs. This agreement could have weakened the competitiveness of Canadian tech companies. Carney rejected the U.S. demand to fully open Canada's financial and manufacturing sectors to investments, which together contribute $150 billion to GDP and create 1 million jobs. Over-opening would reduce the control Canadian companies have in their own economy. Carney rejected the demand to reduce export taxes on agricultural products from the U.S. to below 5%. The agricultural sector contributes $60 billion to GDP and provides 300,000 jobs. Reducing taxes too much could have hurt the competitiveness of Canadian agricultural products. By rejecting the trade deal with the U.S., Carney opened a new direction for Canada, one that no longer depends on trade agreements with the United States. Canada has focused on developing its Arctic resources, which include 90 billion barrels of oil and gas, infrastructure and oil and gas projects worth $10 billion in cooperation with Japan and South Korea are set to begin in 2025. This will not only help Canada assert control over the region, but also enable it to provide energy to countries in the area. Canada signed a $20 billion energy agreement with China and Japan, reducing its dependence on the U.S. Major tech companies from Japan and South Korea have invested $10 billion in R&D projects in Canada over the past 5 years, further boosting the high-tech industry. Carney's leadership has helped Canada decrease its reliance on the U.S. while building new partnerships. The Arctic initiatives and collaborations with Asia have created $30 billion in investment and trade opportunities for Canada, solidifying its position in energy security, resource extraction, and high-tech industries. Canada has ramped up its exploration of renewable energy and oil and gas, with reserves totaling 170 billion barrels. Canada exports 120 billion Canadian dollars in energy each year, with 50% of its oil exports going to the U.S., but has also signed energy deals worth $20 billion with China and Japan. In the high-tech sector, Canada attracted $10 billion in investments from Japan and South Korea over the past 5 years, focusing on artificial intelligence and IT. The energy sector contributes 10% to Canada's GDP, while high-tech contributes 4 to 5%. These investments provide stable revenue and boost Canada's global competitiveness. The Bill C-5 project, Economic One Canada Act, was launched to develop infrastructure and create economic opportunities for the Arctic region, particularly for Inuit communities and other Indigenous groups. The project includes 6 billion Canadian dollars for transportation infrastructure, with 2 billion Canadian dollars allocated to building roads and ports. Additionally, 1 billion Canadian dollars will be invested in renewable energy projects such as wind and solar. The project also dedicates $1.5 billion Canadian dollars to initiatives that promote economic growth in Indigenous communities, creating 10,000 jobs for Inuit people. These investments will not only drive economic growth in the Arctic, but also reduce reliance on other developed regions, enhancing Canada's position in resource extraction and regional security. The EU chose to make concessions and sign a deal with the United States to avoid a full-scale trade war. This decision was not easy, but represented a calculated strategy aimed at safeguarding the EU's interests in an unstable global economy. The agreement between the EU and the US includes a 15% tariff on most products imported from the EU. While this tariff is far lower than the 30% one Trump had previously threatened, it still significantly impacts the EU's key industries. These industries include: the EU is one of the world's largest car manufacturers, with brands like Volkswagen, BMW, and Mercedes-Benz. The EU's auto industry relies heavily on exports to the US. A 15% tariff could increase production costs and reduce the competitiveness of EU cars in the US market. The EU conceded to avoid higher tariffs, which could have severely cut car exports to the US. The EU exports many agricultural products to the US, including cheese, wine, and meat. A 15% tariff could raise the price of these products in the US, affecting market share for EU producers. High-value exports like wine, olive oil, and cheese will be hit hard by the tariff. The EU is one of the leading manufacturers of machinery and industrial equipment. The 15% tariff will reduce the competitiveness of these products in the US, as the US may seek out alternative suppliers from countries with lower tariffs. To mitigate the damage from these tariffs and strengthen economic relations with the US, the EU has committed to purchasing $750 billion worth of energy from the US over 3 years and investing $600 billion into the US economy. This strategy aims not only to reduce the impact of the 15% tariff, but also to maintain stability in its trade relationship with the US. The EU yielded to Trump's tariffs by agreeing to purchase energy from the US to ensure a steady supply and enhance strategic relations. However, Canada under Carney's leadership firmly rejected the deal, prioritizing national interests and refusing to concede to pressure. The question remains, will other countries continue to bend to Trump's demands in the future as protectionist trade strategies become more widely applied? Before 2025, U.S. border towns like Blaine, Calais, Derby Line, Pembina, and Sault Ste. Marie were once bustling stopovers for Canadians, places where they'd come to shop, pick up packages, dine out, and connect with locals. But today, these towns are facing a sharp economic and social decline, as Canadians gradually abandon the habit of crossing the border. And the root cause isn't just tariffs or exchange rates, it's a deeper shift in the relationship between the two countries. Blaine, a small town tucked away in the northwest corner of Washington state, used to be a lively pit stop for residents of Vancouver, Canada. Before trade tensions escalated, roughly 60% of Blaine's retail revenue came from Canadian shoppers, driven largely by weekend shopping trips. According to U.S. Customs and Border Protection, in May 2025, the number of Canadian visitors crossing into Blaine dropped 35% compared to the same month the previous year. That translates into thousands fewer cars crossing the border each month. Blaine, which depends heavily on Canadian traffic, has seen a steep decline in local business. 3 of the 5 largest gas stations have shut down, unable to survive the drop in customers. If each gas station or convenience store used to serve 500 to 1,000 customers per day, a 35% drop means losing about 175 customers daily per store. at an average spend of $20 to $30 per customer. That's a loss of roughly $3,500 to $5,250 per day per store. With 8 to 10 stores impacted across town, daily losses ADD up to between $28,000 and $52,500, totaling an annual revenue loss of $10.2 to $19.1 million. Blaine was also a key hub for Amazon pickup points used by Canadians. But now, over 20 of those pickup locations have shut down, leading to losses of $400,000 to $1 million per month. These locations used to process thousands of cross-border orders each month. Now, that business has vanished. What's causing the collapse? A 25% tariff on steel and aluminum, along with other trade barriers, has driven up the cost of U.S. goods. The CAD-USD exchange rate dropped below 0.7 in June 2025, making cross-border shopping far less attractive economically. Calais, a small U.S. border town nestled along the St. Croix River, used to be a key stop for residents of St. Stephen, New Brunswick. Canadians regularly crossed over to shop, pick up packages, and take part in local cultural events, but since early 2025, that cross-border flow has slowed dramatically, bringing major economic consequences to the town. In February 2025 alone, Calais saw 30,000 fewer Canadian visitors compared to the same month a year earlier. For a small town like Calais, that's massive. It amounts to more than 100 fewer cross-border car trips per day, meaning far fewer customers for local shops and services. As a town that relies heavily on Canadian foot traffic, Calais has struggled to cope with this sudden drop. The effects are widespread and immediate. Local businesses have been hit especially hard. Take C&E Feeds, for example. It reported a 61% drop in revenue during the first 2 months of 2025. That's a staggering decline and directly tied to the absence of Canadian shoppers. Other shops have closed down completely or cut back their hours, unable to sustain operations without their usual customer base. Restaurants and small retailers have also suffered deeply, with the once consistent flow of Canadian patrons now reduced to a trickle. The CAD-USD exchange rate fell below 0.7 in June 2025, its lowest point in 5 years. That made U.S. goods noticeably more expensive for Canadian buyers, with every purchase costing more in Canadian dollars. The economic incentive to shop across the border has faded. New American tariffs, particularly those targeting Canadian imports, have driven up prices on a wide range of products. Many Canadians have come to realize that shopping in the U.S. no longer saves them money, pushing them to look for better deals at home. Canada Post and private logistics companies have rapidly expanded their e-commerce infrastructure. Canadians can now order products online and get them delivered quickly and cheaply without crossing the border and without dealing with tariffs, currency swings, or border delays. Derby Line, Vermont, once known for the Haskell Free Library and Opera House, a unique building that straddles the U.S.-Canada border, has become a stark example of how policy can divide what used to be a shared community space. In 2025, this iconic border town saw a 35% drop in revenue compared to the previous year, driven largely by tighter U.S. border policies. In February 2025 alone, the town lost 30,000 Canadian visitors, which translates to roughly 100 fewer cross-border trips per day. Local businesses, especially cafes and bookstores, have struggled to stay afloat with a 35% decline in sales. With each customer typically spending $20 to $30, that drop in foot traffic has resulted in estimated monthly losses of $600,000 to $900,000, totaling $7 to $10 million per year in lost revenue for this small community. Canadians are now required to cross through official checkpoints, limiting the free movement that once defined Derby Line. As a result, far fewer visitors come into town casually or spontaneously. With Canada's e-commerce sector expanding rapidly, many Canadians no longer need to cross the border to shop or pick up packages. They can simply order online and avoid the hassle. Pembina, once a critical border town in the logistics chain between the U.S. and Canada, is now watching its relevance quietly fade. Formerly a key transit point for cross-border goods, Pembina has seen its role sharply reduced as Canada builds out new logistics infrastructure just across the border in Emerson, Manitoba. According to U.S. Customs and Border Protection, the volume of goods moving through Pembina dropped by 17% in 2025 compared to the previous year. Once handling around 3 million tons of cargo annually, that decline represents a loss of roughly 510,000 tons, a significant blow that translates into millions of dollars worth of goods no longer flowing through the town. Local businesses that depend on Canadian customers like Mike's Parcel Center and other logistics-related shops are now struggling with reduced traffic. Data from the Economic Council of Pembina shows that major international shipping services like FedEx and UPS have scaled back or left entirely, citing the steep decline in cross-border deliveries. These services once contributed 50 to 60% of Pembina's commercial revenue, but with declining activity, shipping-related income dropped 30% in 2025. Take Mike's Parcel Center, for example. It used to handle 200 to 300 Canadian orders per day, but now it's down to 100 to 150, a drop that slashed its revenue by nearly 50% over the course of the year. Canada has poured major investments into new distribution centers in Emerson, building a faster, cheaper, and more efficient domestic logistics network. These new centers, supporting operations by Canada Post and private carriers, now handle over 2 million parcels per year, reducing Canada's reliance on cross-border shipping through Pembina. Domestic freight within Canada has become much more convenient and cost-effective. Thanks to this expanded infrastructure, whereas Pembina once served as a critical transshipment hub, Emerson has taken its place, offering Canadian businesses shorter delivery times and lower costs. Once a vibrant hub for tourism and cultural exchange between the U.S. and Canada, Sault Ste. Marie, located along the St. Mary's River, now finds itself grappling with a sharp decline in cross-border activity. According to data from the Sault Ste. Marie International Bridge Authority, the number of Canadian visitors dropped by 27% in June 2025, delivering a serious blow to the town's tourism economy, especially hotels, restaurants, and souvenir shops. The town is now losing an estimated 400 to 500 Canadian visitors per day, leading to a 30% to 40% drop in revenue for local hospitality and retail businesses. If each visitor typically spends $50 to $75 per day, that equates to $20,000 to $37,500 in lost revenue daily, or roughly $600,000 to $1 million per month.